We're doing the general theory that could be asked when it comes to provision for doubtful debts or bad debts. Tell me, what do you mean by the term bad debts?
Bad debts are irrecoverable debts, which means when your trade receivables don't pay you back.
Okay, so if you have to write, what will you write?
Um, Bad debts are the money which is not received by your trade, which is not yet received by the trade receivables.
Okay. So bad debts means trade receivables which the company is unable to collect from the customers.
Yes,
Right. That a company is unable to collect from its customers. What is bad debts recovered?
it is when the debts which are thought of not going to be paid back to us are paid back to us. So
Amount that is previously written off as bad debts. It means you had previously written it off as bad debts, but it is now being collected from your customer.
yeah,
Okay. So when I'm talking about bad debts recovered, what is it?
it is our
Amounts
previous.
that is previously written off as bad debts that have been collected from customers. Yeah,
Yeah, miss.
come on. Give me the meaning of provision for doubtful debts.
It is an estimation that our trade receivables would not pay us in the future.
Okay, right. It is an estimation that
That our trade receivables would not pay us in the
our trade receivables would do default in future or would not pay us in future. Give journal entries without narratives for the above three terms. So, can you give me journal entry for bad debts?
yeah.
Give.
Bad debts debit, income statement credit, trade receivables credit.
Okay, fine. Can you give me a journal entry for bad debts recovered?
Yeah. Uh, Bad debts recovered, cash bank credit,
Cashbank credit or debit?
debit.
So, it
Cash
would be
bank debit,
cashbank debit.
bad debts recovered, credit.
Can you give me journal entry for PDD?
Yeah. Income statement debit,
The
PDD
fourth
credit.
minus two is negative. Or for creating provisions.
Creating provisions is income statement debit, PDD credit.
And for reducing provisions,
It's PDD debit, income statement credit.
Name two accounting principles. Can you read it?
Yeah, miss. Name two accounting principles which Mr. Shan provision for doubtful debts.
Hmm?
Okay, so are we supposed to name two accounting principles
Yeah.
for what?
For creating provision for doubtful debts. We create provision for doubtful debts in accordance with which principles?
Matching principle and prudence.
Prudence and matching.
Yeah,
Very good. State two ways in which you could reduce possibility of bad debts.
by only accepting cash transactions
Hmm.
and giving cash discounts.
Very good. And giving cash or discounts. Very well. So, why do you create bad debts as per the prudence principles?
A prudence concept requires that all expected losses are accounted for as soon as they are likely to arise in future.
Okay, that is why we create a provision for doubtful debts. Can you tell me provision for doubtful debts is created as what?
As a percentage of the NTR, net trade receivables.
How do you get the NTR?
Trade receivables minus new bad debts.
Okay, trade receivable minus new bad debts. Very good. Why do you create provisions as per the matching principle?
So that the estimated losses on account of likely bad debts are charged to the period in which revenue or income is earned. So, example, the current year.
Okay. So if you have made sales in the current year, you will create provision for bad debts in the current year. Yes.
Yeah,
So the
yeah,
estimated loss is charged to the current year instead of when it actually happens.
yeah.
With this, we complete most of the theory of your bad debts and provisions.